Hi, it's Dwyer. It's February 20th, 2026. Uh, Money1776.com, a free site. Also, keeping it free.blogspot.com, a free site. Nothing I say in this video should be construed as investment advice. I want everyone to do their own due diligence. I'm just sharing with you what interests me, what I might have, what I might want to pursue, right? Trust no one, including me. Your operating assumption is that if I mention an asset here or an investment opportunity, I might already be pursuing it. Remember, the opinion you should follow should be your own. Just consider this video to be a second opinion from a complete stranger online. Now, folks, let me just make a point here. I understand that the Schiller index is inflated. I understand that the Buffett indicator is inflated. But what I want to point out to people is something traders understand. You can make money if you just know the direction of certain assets, right? Understand, options are too risky for most. But these days, you actually have inverse ETFs. You even have different degrees of inversion, right? You have 1x, you have 2x, you have 3x. In other words, the 3x is trying to triple whatever the price movement is in the sector in which you bought that inverse ETF. Understand, you don't have to buy an inverse ETF on the entire market, although you could, right? You can pick a sector and you can say, gee, I don't believe that banks are well positioned for the future with assets on the books like commercial mortgages, right? And you could short the market. My advice to risk takers who want to profit, want to gain money off what's happening in the market is don't assume that the market has to be a bull market for you to profit. Study how to profit in a bear market. Let's make some more points in this video. There was a time when, we'll call them silver bugs, were upset, right? Silver hadn't touched its 1980 high, right? The feeling was that it was being artificially manipulated, that there was a paper market out there where, the paper was supposed to represent silver, actual physical silver, but it didn't, right? That people were actually using the paper as a way to profit without actually owning the silver. So you had a lot of people here online. Some of them are still online. Bill Holter is still online. And they were complaining about the manipulation in the silver market. Now, if I told you that silver and gold, there were also complaints about gold, that silver and gold were actually risk-off assets, many would have laughed, right? Because of the price volatility. People didn't view either as a safe haven, right? Well, focus on the longer term. It's obvious now that gold and silver are risk-off assets, right? That's obvious. Their competition, these sovereign bond markets, are losing credibility by the day with the purchasing power loss that their fiat currencies are undergoing. Right? You see a country like Japan, their debt is almost 2.5 times their annual GDP. Right? They're that underwater. And you just wonder whether you can actually trust them to pay back a 10-year bond. Because, of course, when you're underwater and you're the debtor and you actually have some control over the value of the fiat currency in which the debt is denominated, there's going to be an incentive to water down the value of your fiat currency so you could pay the debt back with watered down dollars. Right, folks? There's no such concern with silver and gold. So, in an earlier video, I made the preposterous claim, it seemed preposterous to many here, and the market has supported them, not me, since that video was made. Let's have a full disclosure that Bitcoin was a risk-off asset. Right? My argument was simply there's a finite amount of Bitcoin. The infrastructure is worth more now than it ever was. In other words, you have banks accepting Bitcoin. You have states in the United States with Bitcoin reserves. You have the President of the United States holding on to some Bitcoin. You have, Russian banks now considering making Bitcoin-backed loans. You didn't have this 3-4 years ago. Bitcoin is much more accepted. So you know the rest. Right? Bitcoin has dropped. It's in the 60s now. It was well over $100,000 a coin. There was a lot of hoopla. We actually had a crypto-friendly president take over. You had a change at the SEC, the CFTC. Right? We thought, Bitcoin to the moon. You had the advent of the Lightning Network. Now you could actually have the transaction speed be almost instantaneous using Bitcoin. And you know the rest. Those giddy times have slowed down. Bitcoin's in a bear market. People are panicking. Right? The critics are coming out. They're saying, Bitcoin might hit $20,000. Right? People now have fallen in love with silver and gold suddenly. Why would anyone consider Bitcoin? We'll ignore the fact that even if I use online silver or gold, there has to be physical silver or gold in a vault someplace. Right? With Bitcoin, the actual value is being transmitted by my phone to the other party as part of the transaction. Right? So while the government can, suddenly declare private gold ownership to be illegal, as it did in the United States with FDR, know your history. Right? As the government could say, hey, all of this gold in this vault, we want access to it, right? Let's say Americans find out there isn't as much in Fort Knox as they thought. Let's say the country's going to hell in a handbasket. You know the stories. People are starving. People need money. There's a liquidity crisis. And folks, guess what? They'll be able to get at your gold. Right? So let me just say, and I know it sounds as preposterous as calling silver a risk-off asset years ago. Right? But understand, as I see it, Bitcoin is still a risk-off asset. The only difference is today, you're getting it a lot cheaper than you would have gotten it 6 months ago. Right? Again, why risk-off? Because it's widely accepted and it's limited supply. It can't be manipulated according to the whims of politicians. Right? I'm a little bit nervous, by the way, about, the Clarity Act and stuff like that. I'm one of those cowboy types who would rather the government not get involved in Bitcoin. But I understand, the government getting involved is going to open the spigot to a lot of institutional money. Right? Institutions want a regulatory framework. Bitcoin is decentralized. That threatens a lot of people. They need some central rule structure, access to, the judicial system, some set of laws that are written down, that are part of statutes, that are clearly defined, etc. Right? But you need to watch these politicians closely. Understand the genius of decentralized finance and cryptocurrency. Right? You have investment vehicles in the crypto world that pay interest. You also have, as you can imagine, big political donors from the financial sector, legacy finance. They don't want competition, right? You need to always ask yourself, who are the politicians representing in this particular interest? Me, Joe Voter, or some bank that has given them a lot of money and that's helping them craft some public narrative about how allowing private crypto to pay interest is somehow detrimental to the health of the country. Let me continue. Folks, a lot of my friends are baby boomers, as am I. Right? We have conversations. You have a lot of old style liberalism in the conversations. One of the conversations going round, this has been a multi-year conversation, is on what should be done with housing. Right? Now let me sound like Malcolm X here. My answer is nothing. Right? Housing has a market cycle, doesn't it? Right? There are times when houses are cheap. There are times when houses are expensive. The people who should get the profits when it's cheap are the market participants. The people who should take the losses when the market turns are the same market participants. Right? If you're someone who doesn't want to rent, believes you're throwing your money away renting, if you actually want to be on the hook for, the property taxes in the area, right? The mortgage payment, the HOA fees, right? The repairs. You have termites, you have to take care of it. You have a leaky roof, you have to take care of it. Code compliance, right? Then you can buy a house, but understand the risk belongs to you, not the renter. So let me say this, and I know it's not a view that's popular, but we should be celebrating the dip in house prices. Right, folks? Too much money is locked right now in the housing market, and it didn't used to be this way. Right? Understand, go back to the 1970s, the early part of the 1970s. You're going to find out that the price of a lot of homes in places like Tustin, California, right, Orange County, understand, OC has a lot of very expensive areas, right? Newport Beach, Laguna Beach. They now have an area that they call the California Riviera. Right? Just understand, Tustin, where you could actually catch the train and take the train up to Los Angeles. People were able to get homes in the early 70s for less than $40,000 a house. Right? Homes now in Tustin are up around $1 million. San Diego, same thing. Go to San Diego. You look at the water, the weather couldn't be better. There's less congestion than in Los Angeles. It's a gorgeous place to live, right? But the prices there are very high. right? We're talking about $800,000 a home. Just understand in the early 70s, an older generation was able to get homes in San Diego, and I'm talking about all throughout San Diego, for $40,000. Right? The relationship between their median income and the price of a home was vastly different than the relationship for later generations in the same areas. So what's happened is that these areas have gotten over levered. Right? People are paying too much of their income toward their mortgage. They don't have enough income left over to actually make investments in stock, right, and other things. So let me just say, now we have the baby boomers passing. We have different demographics upon us, right? The price of houses shouldn't be propped up. Just like they were built up over time to really untenable, unhealthy levels. Just like they sucked a lot of the capital in some cities into just the housing market. Right? You now have politicians, Tom Dwyer here in California, Mamdani in New York City, running on affordability, and housing is a big ticket item. Well, now that things have changed, there aren't as many people bidding on homes. Right? The bond market's falling apart, and financing a home is costing more and more money. Now that things have changed, my point to the world here is to let them change. There are going to be terrible stories of woe in the media. You're going to see homeowners saying, look, I lived here for 5 years. I made all the mortgage payments. I, protected my credit rating. I lived the right way. I mowed my lawn. I kept my house in great condition. Now my house is worth less than I paid for it. Right, folks? They took the risk. You didn't. Right? You need to ask yourself, should there be some government program that props up the price of the house so that the individual homeowner doesn't face the downside? Or is the world better off with the house actually being priced at market and the current homeowner taking whatever loss has to be realized on the home now if they want to sell the house? Right? Sooner or later, gravity takes over. Right? Food for thought. Right? So my point is simply this. What should we do with the downside in housing? By the way, I also run housing777.blogspot.com. Folks, if housing's gonna crash, we should let it crash. The same applies to commercial real estate. Let me point out that I understand these markets are going to be existential for some banks. Right? You understand that as the housing market crashes, as commercial real estate crashes, some banks are going to go under. Some banks are going to merge with other banks. Right? You're going to have more woe is me stories on the news. Right? Someone's going to say, hey, I had more money than was insured at this bank over here. I did everything the right way. Now the bank has crashed and I can't get reimbursed for the uninsured's portion of the account. Right, folks? We have to let it happen. Understand, somebody's got to pay the piper. Either it's the person who took the risk, or it's you and me who haven't in that particular situation. Right? Let's go a step further. And I mention this in almost every video. Right? You have states right now, California, Illinois, New Jersey, right? They have major pension problems. Major. Right? Understand what that means. It means that, when the Chicago Bears want a new stadium, and they have one of the best brands, one of the most loyal fan bases in the National Football League, and they turn to their state and their city, and they say, look, help us with the infrastructure. Work with us on a new stadium. We'll put up X dollars. Right? You provide some so we can stay here, because this is a competitive market. And if you don't help us, we're going to find some other location that will. And of course, Indiana has stepped up. Right? And folks, understand, in Illinois right now, it's iffy on whether the Bears are going to continue to play in Chicago. Right? Because the state, quite frankly, has spent its money. The state also has overregulated itself. So, market participants are looking at all the costs. Chicago's a beautiful town. I have family in Chicago. I have nothing against Chicago. The Bears, of course, made the playoffs. Caleb Williams is one of the most exciting young quarterbacks in the league. The head coach is one of these guys who stepped in year one. You noticed the change, right? But the bottom line is, Illinois, in part, because of its pension debt, is having a hard time meeting the Bears' demands. Let's go one step further, too, and it's very important. It's because we don't talk about pension debt that the governor of Illinois and the governor of California can run for president and look like credible candidates. Right? You would hope the press would, question a Gavin Newsom, right, about California's pension crisis. Understand, Jerry Brown, right, 70s progressive, was the governor of California, and he was focused on the pension. You have some laws on the books here that make, getting rid of the pension debt a challenge, right? The idea is that beneficiaries honored their part of the deal. We even had a ridiculous law on the books here where beneficiaries could actually pay for even more pension benefits. Right? Well, just understand, we don't have it set up legally where the pension holders take the risk of the pension going insolvent. Right? So just understand, you have some governors from some states that have major pension problems that are running for president of the United States, and I haven't heard the reporters who are cornering them on these pivotal issues as they run for an office that has to oversee right now a $38 trillion national debt. Right? I can tell you too, here in California, right, you have a major multi-city commercial real estate catastrophe that's just waiting for the market to break. Right? You saw a private equity firm recently go under. Folks, I'm just telling you, it's shocking that the banks holding the commercial mortgages in places like San Francisco and Los Angeles aren't more under pressure. So you, the investor, you really can't wait for a consensus to develop, right? You really can't. You have to make decisions now, and I hate to tell you this, but you have to be right. There's real risk involved, right? You can't play the hand because this hand now really doesn't exist anymore. You can't play the hand of, hey, I don't know the market. I'm just going to be a passive investor and I'm just going to invest in the entire market. Because now market participants are figuring out that that leads to malinvestment. That companies that shouldn't get investment money are getting investment money simply because they're members of an individual index, right? The NASDAQ, the S&P 500, right? So now the market's being shrewder, right? Stocks, of course, are so hopelessly overvalued in general. Again, look at the Shiller Index, look at the Buffett Indicator. They're so overvalued now that when the dam breaks, some are going to drop by 40, 50%. Right? So, for me personally, as I'm watching Bitcoin drop, right? It hits 90,000, drops below that. Hits 80,000, drops below that. Hits 70,000, drops below that. Right? I still have a firm conviction, and realistically, I've been in crypto for years. This is not the first bear market in crypto. There's volatility, right? I'm looking at the characteristics of the market. The fact that Bitcoin is still limited supply. The fact that Lightning Network recently was able to pass $1 billion in transactions, right? The fact that there's a growing consensus, not that I'm waiting for it, among politicians that Bitcoin is here to stay, right? Larry Fink is into Bitcoin, right? BlackRock, ETFs, Fidelity, right? So as Bitcoin drops, I'm staying with Bitcoin, right? You, the investor, has to figure out what's fool's gold and what's real gold, right? Even when gold and silver are under siege, you have to think to yourself, wow, silver is used in solar panels, it's an industrial metal, plus it's money. You have to think to yourself, wow, if the central banks are buying gold, I have to ask myself, why are they buying gold? China's buying gold at the same time it's telling its banks to get out of U.S. bonds. Why would it do that? Right? I have to ask myself those hard questions. Right? So as I judge political candidates in the 2026 upcoming election and in 2028, right, I have to ask myself what's real and what's not. Someone just got hired, voted in as governor of New Jersey. And she was asked about the pension crisis in New Jersey, which is acute. Right? Look at the numbers for yourself. Ask yourself, what's the per capita debt for the pension in a state? Realizing that not everybody in the state's a pension beneficiary. Right? You're paying for pensions held by teachers, firefighters. Right? And you know the rest. She somehow got through an election where her canned response was simply to say that she's going to honor the pension debt. Folks, I'm just telling you, easier said than done. Some states don't have the money to do so. You need to ask yourself if your state does. You need to insist on media outlets asking these candidates uncomfortable questions that need to be asked. Right, Governor Newsom? How underwater is CalPERS? Right? Governor Pritzker, what are the odds that Illinois' pensions can actually pay every pension beneficiary? Understand, if a pension is 20% underwater, think of 5 people who are supposed to get pension benefits, right? That means one of them's not going to get the pension benefit. That's what 20% underwater means unless something changes. Then do the further math. Say, gee, if we're, 2 times above what would be a healthy reading for the Buffett indicator, right? In other words, if the value of stocks is twice the GDP, and you're still 20% underwater, and by the way, in Illinois, the number is much more than that. You're still 20% underwater during this overvalued stock era. How are you ever going to balance the books? Can the books be balanced? Does the law allow the pension to write off some of its debt or to pay less than 100% on the debt obligation? Those are my thoughts today. Let me hear yours in the comments section of this YouTube video. Thanks for stopping by.